What can you do in a period when share prices are not appreciating too much? In other words, there's no particularly strong rally ahead. Well, one of the things you can do is to buy an enhanced income fund. The idea is that you buy an entire stock index, but by selling options on that index, you can boost its income considerably. Now, to find out how these funds work, what the fees are, and what the risks are, let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. If we're going to be thinking about income, then we have to understand dividend yield. Let's say you buy a share today for £100. Then after 1 year it pays you £5. And after 2 years another £5. And it carries on paying you a dividend forever. Then if we want to think about how much income we get paid for every pound we pay, we'd express this as a dividend yield. We'd add up all of the dividend payments over the last year and divide by the price today. So in that example, we'd have been paid £5 over the last year and we'd have paid £100 to receive that £5 income. And as a percentage of our investment, that would be a dividend yield of 5%. So what is it that makes dividend yield increase? Either the dividend payments would increase, but of course we have no control over that. That's determined by the profits of the companies that we buy and how much of that profit they distribute. And dividend yield can also go up because the price falls, which means that after a market sell-off, the dividend yield becomes more attractive, even though the dividend payments haven't changed at all. So how do enhanced income funds generate greater dividends? In order to understand that, first we have to understand what we mean by a call option. This is the right, but not the obligation, to buy something, and that's a call option. To sell would be a put option, at a fixed price, which is called the strike price, and to perform this purchase at a fixed time in the future, and that's called the expiry. So that might be 1 month, 3 months, or a year in the future. Now you don't have to buy the option. You can also sell the option to somebody else. Or, as in the case of these enhanced income funds, you simultaneously buy the stock or buy a whole index and sell a call option on the stock or the index. To see what that means in practice, consider the profit and loss when you buy a simple S&P 500 tracker. You can see that it moves up and down 1 for 1, such that if the price of the index goes up, we make a profit, and if the price of the index goes down relative to our buying price, we make a loss. With a buy-right strategy, you can see that the option premium, which we made by selling an option, has boosted us above the level of the S&P 500 tracker. But the price we pay for that is if the stock market rallies very strongly, we've sold the upside. There's no such thing as a free lunch in finance. We generated income today by selling upside tomorrow. Another key question is how much we'll make by selling that option. The price of the options changes over time. These are the 5 factors which drive the price of the option. The ones in red are the ones which we don't control, and the ones in blue are the ones we can vary by deciding which option that we want to sell. The price of the option increases as volatility increases, or alternatively we could lower the strike or extend the expiry date further into the future. I don't want to dwell on the option theory here, but if you want more detail, then you can buy my book of Financial Bestiary. This goes into quite a lot of detail for these option strategies, including how to price them, but also more detail about the options themselves. Now there are some environments where this works better than others. Unfortunately, in the United States, there's a whole index which has been constructed since 1986, which shows how a theoretical enhanced income fund would work on the S&P 500 over time. It consists of a long position, in other words, you buy the S&P 500, and at the same time, every month, you sell an at-the-money call option on the S&P 500. And it's a total return index, which means that all of the income is reinvested back into the index. Now, for the purpose of comparison, I've compared this with the total return index on the S&P 500. The S&P 500 is in red, and the enhanced income version of the S&P 500 is in blue. During the very strong rally since 2010, you can see that the buy-right index has underperformed the S&P 500. But if you look back over the periods when the S&P 500 didn't do so well, there was a much closer race between the two different approaches. And that's why in this graph I compare the S&P 500 return year by year, which is on the x-axis, with the enhanced income strategy return on the y-axis. The dashed red line represents where we'd be if the two were exactly equal. And what you can see is that when the S&P 500 is falling, which occurs to the left of this vertical line, the enhanced income fund performs better than the S&P 500. And that's also true if you have a small positive return on the S&P 500. In other words, it's increasing just a little bit. Whereas if the S&P 500 is rallying very strongly, the enhanced income fund lags underneath the S&P 500, as happened in 2017. One of the reasons for that is that when markets fall, volatility tends to increase. Volatility is a typical daily price move, expressed as a percentage. In the upper panel, you can see the volatility of the FTSE 100, and in the lower panel, the volatility of the S&P 500. And because equity markets tend to crash together, you get these spikes in volatility at roughly the same time for both indices. But notice how there are long periods when volatility is either very low or very high. And those periods are often more than 5 years, sometimes up to a decade. And we call those volatility regimes. Now recently we've had a very low volatility regime as equity markets rallied, and that's been fairly toxic for enhanced income funds because the income generated for selling an option decreases as volatility falls. So how are things looking now for enhanced income funds? During the blistering rally that we saw in the S&P 500, volatility tended to be very low. The equity rally in the UK wasn't quite as blistering, but it still meant low volatility. But as markets fell recently, volatility's picked up. And if this volatility continues, it may provide an environment in which enhanced income funds can really prosper. That's how they work, but which funds can you actually buy? I've listed some of the largest enhanced income funds for the UK in this table, and I've ranked it by net assets, so the largest funds are at the top and the smaller funds are at the bottom. I've also included the ongoing charge so you can see how the fees compare, and something which is rather disappointing is that the fees tend to be very high. Now that passive funds have driven down fees, seeing an active fund that charges more than 1% just seems very old-fashioned, very last century. The funds which have the most reasonable fee, which you can see in this column for the ongoing charge figure, are those provided by BMO. The fee is just 0.3% per year for all three of these funds. The top one, ZWEU, gives you exposure to European stocks, but it boosts the distribution yield. In other words, the dividend yield is boosted by selling options on the European index. The middle one is the UK version with the ticker ZWUK, and the bottom one, ZWUS, gives you exposure to the US equity market. Looking at ZWUK, the equity component is the FTSE 100, but as we've seen, you can sell options on the index and generate extra income. And one of the benefits of that is that it reduces the volatility or the risk of the fund relative to the FTSE 100. If we compare it with a passive tracker for the FTSE 100, and here I've shown an example from iShares, the distribution yield for the FTSE 100 via this tracker was 4.19%. Whereas ZWUK had a dividend yield of 6.63, and the difference between the two was a very substantial 2.44%, and that boost came from selling options. If we compare the price of ZWUK versus the FTSE 100, you can see that the two are highly correlated, as you'd expect. But notice that the black line, which is ZWUK, is lagging below the FTSE 100. And that's because of the cap on the upside. Notice that during the rallies, ZWUK rises less than the FTSE 100. And it's always worth looking at the KIID, the Key Investor Information Document, just to check that you actually understand the risks of the fund that you're buying. In fact, this is a little bit misleading because the losses can only be greater than the initial investment for naked options, where you don't own the actual index. So that doesn't apply to enhanced income funds like ZWUK. But what is true is that many years of capital underperformance could make an enhanced income fund underperform very considerably. So these aren't the kind of strategies to buy and hold for decades. They work best when you get just mediocre returns on an index. These funds still expose you to the downside. In the case of ZWUK, you're still exposed to the FTSE 100. Leverage risk is another mistake. In fact, you get less volatility for ZWUK than you would for a FTSE 100 tracker. But it's certainly true to say that you have huge UK concentration risk. This would only make sense if it's part of a diversified portfolio, where you buy equity from other global equity regions, such as the US, Europe, or Japan. So these funds aren't without their risks. If you get it wrong and there is an equity rally which is very strong, you're going to miss out on that upside because you've sold it. But still, if you think that markets are going to track sideways and you're right, or even if they start to move down a little bit, these funds could provide you with a little bit of a cushion by selling options and selling the upside that you don't believe in anyway. We hope you found that video useful. If you want to see them continue, then please consider supporting us on Patreon. For as little as $5 a month, you can join our Slack channel and join our weekly calls on Sunday evening and ask any question you like, as long as it's about finance. And if you pay $10 a month or more, like Robert Bradbury or Ian Stenton, or $15 a month or more, like Andrew McMillan and Kishore Bhagwat, then you get additional benefits, such as a power hour with me every month, or particular analysis of your portfolio to look at the risk and the potential return. So please do consider supporting us. It would be lovely to see you on the weekly call. And as always, thank you for listening.